welcome to this special session on Outlook on Global and Domestic Factors Affecting Consumer Sentiments. I'm your host, Pallavi. This session will talk about the impact of interest rate and other macro factors on your investments, and we'll talk about strategies to make inflation-proof investments. I'm happy to be joined by my experts, Chirag Mehta, CIO Quantum Mutual Fund, Rohit Berry, CIO True Bacon, and Vishal Dhawan, founder Plan Ahead Wealth Management. Welcome to the program.
Thank you, Pallavi.
Thank you.
Let me start with you, Chirag, first. If we talk about the global economy, I would like to, shed some light on the latest UN report. Now, the report says that the global economy is now projected to grow by only 3.1% in 2022, which is down from the earlier forecast of 4%, which was released in January 2020. Now, what impact do you foresee on the Indian economy, considering the current scenario and the market momentum that we're seeing? What's your outlook?
Sure, Pallavi. So yes, we are seeing that global slowdown very visibly. If you refer to the same report, it still maintains India's growth at about 6.4%. So if you look at the long-term history of India's GDP growth, it has been around that 6.1% mark. So look at India's savings, look at India's consumption, look at the infrastructure we have. We believe that sustainability, India will grow at 6.5% real GDP growth rate. And despite the slowdown, it still is in the vicinity of that number. So overall, still 6.4% growth rate is very respectable growth rate as compared to the world. It's higher than that. And long term, we have seen across government since 1980 till now, we have grown at that 6.1%. So not much changing for India. India's sustainable growth rate is still the same. India has good levers going for itself. Look at the IT sector, it's doing really well. And IT hiring, which is good paying jobs, are increasing significantly. So that is one lever that we see. Second lever that we see for Indian economy is real estate. We have seen real estate activity pick up thanks to affordability increasing. So over years, incomes of people have gone up and interest rates have gone down over a period of time, though they have been inching higher now. But still the affordability stands at levels where we were close to 2002, 2003. So from that perspective, and real estate is a big driver for the economy overall, because once a person buys houses, they buy various ancillary things along with it. They buy electronics, they buy consumables, they buy furniture, fixture, etc. So it has good cascading effect on the economy. And third is government spending. So government spending has been significantly large, is going to be significantly large this year, and which will also, drive economic activity. So apart from certain commodity prices driven investment by corporates, government spending is another big lever. So overall, I think India is very well poised when it comes to growth, much higher and more sustainable growth than the global world. And that will drive, the economy and the earnings for companies within the economy.
Surely on that note, I'll move on to Rohit now. Rohit, to begin with, what's your outlook on Indian economy?
I think on the outlook side, I'm pretty much with what Chirag just mentioned, that I think from a sustainability perspective, India is doing pretty damn good right now. Honestly, I would have expected numbers to not hold this good as much they are holding, given the inflation which we are going through. Tells you a little bit about our resilience to global shock factors, despite oil pricing hitting corporate bottom lines. But we have seen commodity prices cooling down over the last few months, partly driven by fear of slowdown in demand, but partly also overall correcting, the prices became unsustainable. At the moment, I'm not worried about economic shocks immediately or in this thing, but I'm definitely cautious about it. If global growth further slows down, then it can have potential negative impact on India, because if global economy 3.1% doesn't hold up, there could be potential impacts on IT spending from global giants, which could cause some pain to Indian equity markets, given that IT is an important export from India. So I think that is something to watch out for. As of now, I do not see signs of concern. Where I'm concerned about is inflation On the asset pricing, real estate, as again Chirag pointed out, is very robust demand, and that is good for the economy in general. Having a robust housing demand, Deepak Parekh said it's one of the strongest demand he has seen. What I'm worried about is on the other side that inflation combined with this strong housing demand, does it lead to massive asset price inflation? Because in India, real estate generally tends to outperform the inflation index very well. And that can cause, again, long-term structural problems for our economy. Chirag talked about affordability has increased, and I think that's a really good thing for our economy. And I think that is something we need to watch out for. Not concerned at the moment, but I'm definitely, from an equity markets perspective, would like to play defensive. And even more defensive when it comes to fixed income. But point on Indian economy overall, somewhat bearish on the market in the near term. I think there is still some pain left, and market is in the correction mode, and I think it will continue over there. But economy, I think I'm good about. We have good feeling about it.
Sure. Vishal, what should the investors think? Should they be worried? What should be their strategies be at this point in time, and probably your outlook as well? I'd like to share that with the ET viewers.
So I think there are in addition to everything that Chirag and Rohit have just mentioned, I think as an Indian investor or as an Indian consumer, wherever you might be, I think high oil prices are typically something that you should always be worried about. And I think there's no evidence yet that oil prices seem to have a sustainable sort of solution in terms of prices coming down meaningfully. There've luckily been a little bit of a correction over the last couple of weeks, but how sustainable that is still going to get questioned because a lot of the supply side issues are yet to get sorted out. So I would always say that if you are investing in India and you are seeing high oil prices, you need to be careful. Obviously, what India does have is strong domestic consumption. What India does have is a bit of an export surge that has been happening in the last few quarters, and that's good news. But I would generally suggest that everyone needs to be cautious until we start to see oil prices come off. The other bit which definitely I think we all need to worry about is how employment data plays out, because what one is starting to see is a lot of the huge surge in employment is starting to slow down a little bit, either because there are demand concerns coming globally, or because there might have been a little bit of an over hiring that might have happened coming out of the virus. And therefore, if one is going to end up looking at markets today, one will also want to see whether sustainability of demand will come through jobs remaining strong. We're already seeing some early signs of some of the hiring, slowing down. And I think if that continues to happen, combined with oil prices being elevated, I think you would have to be very careful as an investor.
Definitely. And Chirag, there's another thing which is very crucial for investors, which is the inflation. So if I quote the UN report again, global inflation is projected to increase to 6.7%, which is almost twice the average of 2.9% during the 2010-2020 period. So with sharp rises in food and energy prices, which Vishal was also referring to, what in your opinion is driving the food and energy inflation worldwide, and how do you see the trajectory in the near future, also in the Indian outlook? Yeah.
Sure, Pallavi. So what we saw was because of COVID, there were supply disruptions and there was a lot of handouts being given by governments. So that led to a very strong demand recovery. Plus, there were supply chain bottlenecks that continued because of COVID disruptions and because of what happened with Russia-Ukraine war. Plus, you had higher commodity prices and higher energy prices, especially that fed into prices of goods and services. So overall, we are seeing a good mix that is driving this inflation trajectory and may likely remain higher because we haven't seen a pass-through of much of the commodity prices completely happen. And as it happens, there will be second round effects in terms of commodity goods and services prices going up, wages going up, etc. So that will be the second round effect, which is yet to come as yet. So what are, from an inflation standpoint in India, I think government has done some measures like cutting excise duty on fuel products, increased subsidy on fuel, fertilizer, and cooking gas, and other measures to contain inflation, like for example tariffs, or putting allowing exports, not allowing exports, and curbing imports overall. So overall, there is likely to be higher inflation because we have a resolution on the Russia-Ukraine situation. There is likely of an oil embargo announced in Europe, so that is also leading to higher energy prices. So there has been some cooling off of certain commodity prices, but we may not see a significant cool down. And that has also happened because of disruption in demand, or fears of disruption in demand, and not really commodity supplies improving overall. So we may have to live with a little higher inflation for some more time, and that needs to be priced in when investors.
In fact, Rohit, what's your view on inflation? I mean, investors, how can they safeguard their, investments from inflation, which is a factor which needs to be, considered while people are making their investments?
I think it's a very important and crucial factor at this point in time, right? Last 10 years, we have been in this Goldilocks zone, where globally, not just in India, globally, we have seen low inflation environment combined with moderate to high growth. That's been a phenomenal environment where whether you were investing in bonds or whether you were investing in equities, everything rallied, and with a very reasonable amount of risk, you could generate decent bit of returns. We are out of Goldilocks zone. We are definitely moved to high inflation scenario. The question which is unanswered is, have we gone into low growth environment? I hope not. Growth has definitely taken a hit. I believe we are not, at least as of now, haven't entered a recession or a low growth environment. We have definitely seeing a slowdown. Inflation, in my mind, as Chirag pointed out, is going to be sustained for some period of time. I do not think oil prices are going anywhere south anytime soon, given the Russia-Ukraine situation and everything else that is evolving around us. Hints out to higher oil price sustaining for a considerable period of time. All the measures which whether the Indian central bank or Indian government is taking or global central banks are taking, I think it's going to take some time to pan out. In this framework, I will be very cautious as to my investments. I do not think neither in India nor globally, bond fixed income yields have caught up to real rates continue to be negative. And I do not see an environment where real rates are turning positive and it will be attractive for investors to say, let's start buying bonds because the rates are high. Maybe 6 months, maybe 12 months down the line, that situation will emerge. I will also be cautious on risky credit because with rates rising, risky credit can become further risky. So that puts us in a very tricky situation like where do you go and invest? In my mind, real estate is one area. Lower duration bonds, basically saying, I don't want to earn zero because of inflation, let me get something out of it. So sit on cash, but earn something. And finally, look at defensive equities, right? You can look at, for example, in Indian case, but be very careful about investing in government-owned corporations. But some of the well-run government-owned corporations are quite cheap at this point in time. That could be one area. Banking looks pretty decent bet to me at this point in time as well. And if you think global growth is not going to go further slow down, IT is also a potential. Large IT companies could also be a good potential safe haven for the time being. That's where I will focus on, try to play defensive. Try to just say, can I stay above water by beating inflation rather than saying this is an environment to get very fancy or risky. And see what happens 6 months down the line. Because if the inflation story turns around, RBI measures starts coming into the picture, we will get a good outlook what's going forward. But it's not a time to get adventurous.
Definitely not. And I'll go back to Vishal here. Vishal, you heard what Rohit said and what Chirag mentioned. So, amidst the whole situation, amidst the Russia-Ukraine war, amidst the higher commodity prices and potential negative spillover effects from the monetary tightening in the US, how do you read the situation for Indian investors? And would you like to advise them some tips or strategies they should follow at this point in time?
Yeah, so clearly, I think just like the central banks globally keep reiterating that, let your investment strategy get sort of led by data, which is what, everyone is now doing. I think even with investing right now, investors need to sort of just go easy. I think what a lot of people are trying to do is become very predictive in terms of outcomes, saying, either they are too bullish on one side or they're too bearish on the other, saying that, all of these problems are going to end up in a 1970s sort of period once again, where you see 10 years of maybe stagflation or very, very low growth and high inflation coming through. I think the way we would sort of suggest investors look at it is, number one, your only real protection during these times has always tended to be very solid diversification. And I think one of the things that tends to happen when you go through these kind of environments is you're trying to pick that one asset class or those two areas that you can invest in. Our view is you have to be as diversified as possible, because depending on how the data comes in, you could either see, domestic Indian equities do really well, or maybe if, for example, global equities are already at valuations which are maybe in line or below long-term averages, you could see international equities actually come in and become a sort of relative savior. You could see bonds either at the long end, more sort of because they seem to be pricing in a lot of bad news already, or you could see, very short term sort of bonds just be the safe place. So I think ultimately in these environments, it's a good idea to be very diversified. Number two is it's great to hold some cash, because if there is panic which sets in on the basis of some events that take place somewhere, I think long-term investors need to use that opportunity to come in and deploy that cash. And last but not the least, avoid any sort of bravado. I think what we see very often is this sort of desire to say that, I got to bet my house on everything at these points, because if I get it right, I can become very, very wealthy. And we think these are not those times where you go out and bet your house. We've been through multiple cycles of this kind, and we found that these cycles can last much longer than what you and me can predict. And therefore, it's good to just be a little careful and not go overboard with a lot of these ideas.
Sure, we'll discuss this in more details, but I want to take a quick question from Chirag, specifically for the mutual fund investors. Do you think mutual funds are also vulnerable to interest rate risk? And if you could also just share your thoughts with some examples or some elaboration, Chirag.
Sure, Pallavi. So if you look at what we've seen from an inflation perspective, this is not the first time we are seeing that high inflation prevail in India. We have seen much higher levels of inflation, like 9-10%, even prevailing before. And so Indian consumers, Indian investors, Indian companies have been through such inflation cycles before. And from in terms of rising interest rate environment that has been triggered by rising inflation, we have seen in each of the past rate cycles, if you look at past 4 rate cycles that we have seen, each of the rate cycles, equity markets have given positive returns. So it's not that it will impact returns very significantly or lead to very negative returns. Investors need to stay invested, and there is going to be impact on certain type of companies more than other companies within the sector or within the overall equity markets. So if you look at companies with where valuations are high, they are bound to be impacted, because as discounting rates go up, the higher PE stocks will get impacted much more because of the changes in interest rates. Second, highly levered companies will be impacted more, because high leverage companies will see pressure on earnings due to interest costs going up. Third, we'll see high growth companies also will see compression. Over last few years, what we saw was money was abundantly available and money was cheap. in the developed world, we saw interest rates prevail around 0%, or even in Europe, we had seen at times negative interest rates on a nominal basis. So given the scenario that we are entering into, which is high inflation, high interest rates, etc., when money is being pulled or by the central banks, high growth stocks could also see that compression, because the present values will decline as the discounting rates go up. So if you're looking to build a portfolio of equities, and as valuations have come down significantly from what they were, it does give you an opportunity to build your equity allocation at these times. So a portfolio comprising of businesses with reasonable valuations, less leverage, will be best suited in this environment. Rising interest rates will also has been a factor that is driving foreign investors out of Indian markets, and that has led to valuations becoming more reasonable. But I think this is an opportunity to build and look at pockets where valuations had already becomes reasonable. Markets are pricing in a lot more in terms of impact of interest rates and inflation. And I think investors should, look at, for example, value funds at this point in time, which could give them, a solid entry point, because valuations becoming reasonable. They already have a cushion available for them. So that could be an ideal investment for them to look to, or look at, quality portfolios, which are not significantly overvalued at this point in time, or give you that, upside in terms of potential earnings growth over the next couple of years. Because quality companies, when I say quality companies, it's those companies which tend to have that pricing power to pass on those input cost pressures over a period of time and normalize their margins sooner than rest of the companies. So those are pockets where you could look at opportunities at this point in time.
Surely. And Rohit, if I were to ask you the same question, like what your thoughts are for specifically for mutual fund investors, those who are just planning to start their journey and probably are a bit confused looking at the market momentum, is there any specific thing that they need to follow, Rohit?
If somebody was entering the investment universe right now, I will give the same advice as Vishal, that diversification is very, very crucial. But not just diversification across assets, but as I said, in time as well, which means if you're looking to deploy X, only look to deploy 1/10 of X right now, because in my opinion, you will definitely get better opportunities down the line, given where we stand today, both in equity markets as well as bond markets. So I would personally tell investors to stay a lot in cash. Maybe if they want to look at a hedge, they can add on some gold to the portfolio. Generally don't recommend it, but I think it's a good time to have some gold in the portfolio. While I'm not super bearish where gold will give you massive amount of returns, but if things do go south, it will be a good asset that you are holding on your balance sheet. Second aspect is I will stay away from the timing from growth stocks completely. Most growth stocks have a potential that their earnings are year-ended, and their valuations are all about the earnings in future. And as Chirag pointed out, discounting rates will hamper them a lot with the interest rates going up. Other things I will also stay away from is leveraged companies. With the companies who have large amount of leverage on their book, they will be negatively impacted by the rising interest rates, provided the leverage is floating and the refinancing is coming soon. If somebody has a very long-term refinancing, they're probably benefiting from it because inflation will actually bring the real value of the debt down. So those are the aspects you need to be thinking about at this stage. If I were to give advice to investors, I will tell them focus on earnings and cash flows. Companies which have earnings, immediate cash flows, positive cash flows, and earnings, short-term earning growth rate is good. Those are the companies I want to go at. Even more than valuation, that is the aspect I will be looking at, because value measures can sometimes be tricky to evaluate, but cash is king. So that's how we are thinking about it. But we run much more active book than an active, let's say, a mutual fund, which is sometimes not very easy to execute in a mutual fund or a personal portfolio. So, but earnings and cash flows is where my focus is right now.
Sure. In fact, Vishal, since we're talking about diversification, this question is, something which is very pertinent to us. After the RBI's unexpected rate hike, what is your opinion? Do you think FD rates have again become very attractive? And at this point in time, what should investors, be doing about their debt investments, and probably what should they be doing about their equity exposure? And also, Rohit mentioned about gold. So, in a scenario like this, is there any formula you would suggest, or ask your investors to follow at this point?
So I think a few things for sure. One is that, like always, when you are investing, you should be expecting the unexpected, and that's what the RBI did. I think the first sort of reaction to the rate hikes were obviously fairly negative, simply because it was unexpected. And I think as an investor, the moment you are embarking on buying products that are exposed to market movements, whether it's equity or fixed income, you will have to get used to this happening. Of course, the triggers could come from different places, sometimes domestic, sometimes international, sometimes political. So there can be so many things that really influence price movements of assets. But I think for most investors, they need to step out of the comfort zone of being in deposits, simply because in a high inflation environment, you are going to be bleeding on a real-time basis if you run a purely FD portfolio. Even though in the short term it may look like a very good strategy, because at least your capital looks protected, because its nominal value is more than what you've invested. So I would say that you're probably at the early stages of the rate hike cycle in India as well. And therefore, if you are looking at fixed income kind of opportunities, a large part of it you may want to invest in shorter duration, so that you can reinvest at higher rates as interest rates keep going up. You could do that either through short-term fixed deposits, especially if you're in a lower tax bracket, or if you're in a higher tax bracket, maybe you might even consider using some of the mutual funds because of the capital gain efficiency that comes with them once you hold them long term. On the other side, if you want to replicate the advantage of a fixed deposit of not really having to bear any sort of real losses if you hold to maturity, then I think you could look at target date index debt funds as an alternative as well for a part of your portfolio. So effectively, you try to barbell your portfolio with having some money at the very short end and maybe a little bit in hold to maturity products as well. On the equity side, I would tend to believe that for most mutual fund investors, I think they need to use some element of index funds simply because they want to get low cost market returns without any fund manager risk. And on the other side, I would suggest that they leave the decision on what to buy to a fund manager. They essentially pay fund management fees for that job. And therefore, if they buy some one or two flexi cap funds which have good track records, I think they should be well served. My only additional piece, which I mentioned earlier as well, is that you may need to combine this domestic strategy with some allocations internationally as well to just protect against two big risks that exist today. One is of huge dollar strength, which might continue to happen if the US continues to raise rates aggressively. And the second is, if oil and commodity prices don't correct substantially, then you run the risk that as a commodity importer that India is, the economy and companies in the economy don't do as well as a result. As far as gold is concerned, we continue to believe that for most investors, a 5 to 10% allocation to gold tends to be good enough. Again, part of the benefit comes through the sort of rupee weakness that it protects against. And part of it just simply comes because of its negative correlation with equities in a portfolio. So I would say that, all of these things happening together, and like Rohit was mentioning, if you haven't done it yet, do go in gradually, try to stagger your investments, use cash to your advantage if you see things getting to panic mode. But I think, some element of averaging will also be very useful.
those were some good tips and quick tips for our investors. Also, Chirag, since we talk about gold, it has always been seen as a hedge in times of crisis. So, any suggestions you would like to give for risk-averse investors, or do you think, or would you agree with what Rohit mentioned earlier, and Vishal also kind of reiterated that a 5 to 10% could be a nice strategic move for investors? What are your views overall on gold?
So we think that gold is a must-have within portfolios. It's an essential element of diversification that an Indian investor can have. So what we say or what we tell investors, that what we have seen work beautifully over different time frames, be it the global financial crisis, be it the taper tantrums of 2013, or be it the COVID crisis, that a 12-20-80 formula work really well for investors, where we say that 12 months of your money should be parked in a really safe place, so that if there are contingencies like COVID and you lose your jobs or cash flows, you can survive in the meanwhile. And that remaining amount of the 12 months of expenses should be split into 20 to gold and 80 to equities. 20 has worked very well in terms of diversifying your portfolio and really counts when it's needed. So when we saw markets fall down sharply, or even this year, for as an example, gold is only the last man standing tall, because it's still positive returns and everything else is negative. If you even look at bonds have not, given or protected your portfolios as much, because with the interest rate increases, we have seen negative returns on bonds as well. So gold is one which is positive, and the likes of, diversification, much being talked about, for example, Bitcoins, etc., have all gone very, very negative, and showing that they are more speculative investments rather than any diversification that they bring to the table. So overall, that 12-20-80 allocation formula works really well. And within each of those, as Rohit and Vishal have alluded, you need to diversify. So even in equities, when you invest, it has to be split amongst different styles of investing, because you never know which style is going to work with when. So some in growth, some in value, some in quality, etc., should be split very, very well, because that's a big chunk of your allocation. That's 80%. And if you follow this for a long duration, 10, 20 years, I think investors will do well to meet their financial goals.
Sure. Rohit, would you have like a similar advice, or do you think the portfolio mix could be dependent on very many factors, like the investors objective? Any thoughts on that, Rohit?
So see, yeah, so portfolio, how you construct your portfolio is dependent on each and individual investor, right? Where they are, what is their risk profile? Somebody who's have 100 crores lying around versus somebody who needs, has only a couple of crores in the bank kitty, the portfolio cannot be the same. But it's again coming back to what Chirag and Vishal said. This is not the time to get adventurous. Stay safe. I love low duration bonds. I want to stick my cash over there because I believe there are good opportunities, and I want to deploy them in risky assets, just not now. Want to keep the cash ready, ammunition ready for 3 to 6 months down the line. When we have a clarity on how long this interest rate upcycle is going to last. As Vishal said, we are very early in the interest rate upcycle. Is it going to be 200 basis point up move over here, 100 basis points up move, or 400 basis points? I do not have an answer to that as yet. So there is a little bit of a clarity that is required. And also, as a world, global economy, we are re-entering the phenomena of inflation and interest rate upcycles after more than a decade. So I think we have to watch which companies are able to adjust to that new world and which will not be able to, come to terms and actually go down. And I agree with Vishal. This is not the time where you say, listen, I will pick stocks myself. It's better to go out, let fund managers do the job, who can very quickly and more efficiently move the portfolio around as and when needed. But I continue to be very, very cautious and somewhat bearish on the market. And Chirag talked about Bitcoin, and I've been perennially negative on that sector. I will say these are not assets at all. These are speculative assets. These are Ponzi schemes where people are fooling themselves, in my opinion, and should just stay away from them. Every time there's a crisis, these supposed asset classes do not show any kind of diversification. They're the first to fall. So stay away, stay safe, be in cash so that you can get opportunities to invest in the right kind of assets pretty soon.
Surely. On that note, I would like to take a question from Vishal. Any investment trends that you've noticed recently? Somehow Rohit and Chiragu talked about Bitcoins, but is there anything else you've noticed recently among Indian investors? Any views on that, Vishal?
Yeah, so I think two things are starting to happen. One is that there's a little bit more focus on asset allocation. I think people are looking at multi-asset products much more carefully now, because I think they've tried their own experience and their own hand at going overweight on a particular asset class. They've had some great experiences and some not so great experiences. And therefore there is recognition coming into the fact that there may be some value in being able to put a basket of securities together with some sort of a mathematical model behind it to be able to rebalance these portfolios on an automated manner. So the huge sort of movement of monies that have happened to dynamic asset allocation funds or balanced advantage funds, for example, could be the start of what I would believe is a fairly healthy trend, because a lot of individual investors may not be able to get their asset allocation right and also have the discipline to follow it on a continuous basis. The second thing that we're seeing is this movement towards passives, both on the equity side as well as on the debt side. And I think that's certainly helpful because, again, the sort of only controllable variable for most individual investors when they start off is the expenses that can be associated with the investments that they make. And because both on the debt side and equity side, most of these products will tend to be very, very cost effective. I think they're doing themselves a great favor by at least keeping costs down. I think the third thing is clearly the movement towards investing systematically. I think this started off a little while ago and it's got stronger. I think the numbers have been remarkably steady so far in terms of SIP flows, for example. And I think that augurs very well in terms of the fact that if you can keep this going through downturns, then most of the times your outcomes at the end of 10, 15, 20 years are likely to be very healthy just because of the benefits of rupee cost averaging that you'll get.
And before we let you go, Chirag, just one last question from you. How long do you think these factors, because this is a continuous process, right? And do you think global and domestic factors, as of now, they'll continue to dampen consumer sentiments, and to what extent? I mean, how would you summarize the entire thing?
Yes, Pallavi, we are seeing clearly that one trend, despite all the talk about dampening consumer sentiments, we are still seeing robust activity at the ground level, and we believe that we are on a cusp of an economic revival, which will continue. Of course, there are certain risks to that recovery theme that persist, given that there could be impact. Because if you look at large companies in India getting larger, and small and medium enterprises are facing a hard time. So overall, if there is further impact on that, then probably there could be, a certain dampening of consumption that happens at that level. But barring otherwise, we think that, of course, another risk is a bad monsoon. If we get at all, then probably that could also impact consumption. So overall, we think that, as I said, inflation cycles we have seen before. We have gone through those cycles before. India is much shielded from, say, for example, food inflation, because we are good producers or larger producers in many of the food commodities. Plus, we had enough stocks. So from that perspective, India is much shielded from the inflation increases that the global world has seen because of rising food prices as well. But having said that, that aggressive tightening by central banks is kind of triggering a global recession. But India is still better poised as compared to the global world. Rising inflation and weak state of small and medium enterprise, as I said, may impact consumer discretionary spend going forward. If there is an extended war that will disrupt the supply chains further and push commodity prices further higher, that is also we need to watch out for, and the monsoon. So apart from these risks, I think we are much better poised. Markets are pricing in much of the downsides already. So if you look at the bond yields, we are already at around close to 7.6%. So it's pricing in much more further increases than rate increases from RBI. Markets valuations have come down significantly. So overall, there are signs of worry in terms of what's happening in the global world and domestically. But still, as I said, India is better poised. So I think any downsides from here would be a great opportunity to increase your equity allocation. But having said that, one mantra that every investor should follow is to diversify and have allocations rightly so in all asset classes.
Surely. And Rohit, my last question to you would be on immediate factors you believe investors should be prepared to deal with.
I think one investor should be prepared for the volatility. Volatility is here to stay for some period of time. We got used to a very amazing decade of very low volatility and reasonably predictable returns. I think that period in my mind is over, and at least for next couple of years, it is going to be tough in terms of what to buy, when to buy. So my advice to investors will be very careful. Ideally, do not try to do it. It is not a time when you say DIY. Go to experts. Best strategy is diversify across time and across funds, and let fund managers do the job rather than trying to figure out what to invest in. I agree with Chirag. Fundamentally, Indian economy is in a pretty good situation. I'm not worried about the economy in general. There will be some negative effects from inflation, but you need to be careful. If there are global spillovers which come through, India will be hit. And at the moment, I don't see that as a major concern as the economy is concerned. Markets are a different thing. I think there is some more pain to come in the markets. While valuations have definitely corrected, the sentiment continues to be negative, and I think there's a room for further correction in equity markets. So I will try to stay very conservative and look for opportunities as things start stabilizing in 3 to 6 months' time. That's when I would say, okay, risk on. But at the moment, stay safe, stay conservative, and diversify across not just assets, but time as well.
Sure. So Vishal, your closing comments on the entire discussion that we had, and probably your word of caution or 2 cents for investors.
So very clearly, I think we are in a place of I would say significant uncertainty. I think a lot of people have been expecting this to happen for a while, but whenever it does take place and you see this downward volatility happen, it creates its own concerns, and everyone starts to worry about how much lower you can go. I think it's only a good idea right now, in our opinion, to just be cautious, but also ensure that you don't overhold cash while all of this is happening. Because very often, if you start timing the market too much, you run the risk of looking back and saying that, I really can't deploy this cash because just a few weeks ago, it was available at a much lower price than what it is today. So I think, let the timing happen by the experts. If there are certain fund managers who are going to take cash calls, let them take that decision rather than you as an investor. Allow your money to go in gradually. If you think that you have the liquidity already available, you have strategies like systematic transfer plans in mutual funds that you can use, which will automatically move the money over the next 6 to 12 months into asset classes that you might like. And, we would only just say that keep a close eye on what's happening to your own job and your own income. Because as long as you don't require money from your investment portfolio to support daily needs, or even your annual holidays, for example, I think you're in a good place. If you get any sort of sense that your job is at risk, I think you may have to very clearly look at your investment strategy very carefully and decide how you want to adjust it in light of the change with your income.
Thank you so much, gentlemen, for your insightful thoughts and sharing your experience here on this platform and sharing your outlook on global and domestic factors affecting consumer sentiments. Thank you so much.
Thank you
very
for
much,
having us.
Pallavi.
This was part of our series for thoughtful investors, where we tried to provide you simple solutions for your lifelong investment needs. Hope you enjoyed. Thanks for watching.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.